Welcome, ladies and gentlemen. Today is June 16th, Thursday, day after the Fed. And the Fed has now raised rates to approximately 1.5% Fed funds rate, which updated in my Fed moves ratio spreadsheet shows us that they are attempting to destroy about 2.28 times the actual growth of M2 over the past year or so. And what that means is that they are attempting to really take the wind out of the sails. Now you can see I've done these ratios showing the high and low ranges, how much destruction has taken place with the Fed raising rates. You can see here we're at 8,336%. If they raise again to another 0.75%, taken up to say 2.25, then we're going to be at a massive 12,700%, which is almost equal to what happened here in the destruction of economic capacity in 2019. Now, this does not match the 2.25 here. The reason it does not match with regards to this ratio is simply because M2 has expanded by so much over the past 2 years. This was a process of 14-year expansion in M2. This is a process of a 2.5-year expansion in M2. So you can see it's gone considerably higher. And what we need to do, again, ladies and gentlemen, is understand that the destruction of this economic process is going to hurt. So what I want to focus on is this, the SPY chart weekly. This is my Fibonacci modeling system. I call it TT pivots for trade tank pivots. It is an adaptive modeling system. It adjusts as it goes. Adaptive modeling means it's a form of AI. It learns as it goes and makes adjustment as it goes. You can see here on this chart that it's identified a major low here in the low of 2020, major high back here in early February, mid-February, and now we have a major high forming right up here in January 3rd of 2022. This is a weekly chart, and you can see the projection levels it's holding from this level, which eventually this will form into a new pivot. But what this is showing us, ladies and gentlemen, is that we have support right here at around 360 and 340 on the SPY, and that's really where I think things are going to go with regards to this downward move. If I were to draw a picture, and I'll show this to you on another chart, if I were to draw a picture, I would say we have a little bit of a downward move and then possibly some sideways before we see an upward move. The reason being is we've already had an A, B, C, D, and this would make E correction, completing a 5-wave or an initial wave down. We would need to then see a corrective wave back up, which is going to, again, hook people into thinking that, oh, the bottom's in, we're good to go. No, this is really just the start of a much broader signal. So if we take a look at this from a monthly basis, you'll see here, I'll kill some of these. You can see here we've got the 2020 lows, the 2020 highs. We'll go all the way back. If this is a broader term correction and we're looking for the markets to attempt to move lower, you can see my downward projection levels with the Fibonacci system are much, much lower. This one's below 0. So we have to ignore this, but this puts us back down into the 174 roughly area. So in theory, as this moves forward, these will create new pivots and new rotational models will come into play. But as I've always been saying, we have two areas of support and resistance. We have this 2015 range, which is right about there. And then we have what I'm calling the midpoint of the 2020 correction, which is right about here. And these are the areas that I think we're going to likely see some support. So understand, from this level, if this were to end up being the end of wave 1, we would see a correction back up possibly to this area, which is where this support area is. Then we would possibly see another wave formation down to be able to end somewhere in this area near these COVID lows. And if I were to try to draw a line, you can see here the low here in 2018 becomes a very critical area, I think, for us long term. I'm going to try to mark this on the chart so you can see it. I think that area becomes a very critical area for us long term for a low in the 236 area. Now let's go to the Nasdaq and try to take a look here. Same type of scenario. Let's see where the Fibonacci system comes in and shows us support. Fibonacci system is showing us support in the 4,000 range, right down here, 3,972, which does somewhat align with the 2015-16 range. You can see it carries all the way across to about here. And we need to watch this mid rotation here, which I would draw from here to here. And on the weekly chart, let's go ahead and take a look at the Fibonacci system to show us where it is projecting lows. And you can see the lows over here. So we've got the first target range right here, which we're already below. The second target range is right here, and the third target range is right here. Try to get those into play. So really what we're looking at here is a continued move lower in the Nasdaq. We're below this area. I still think we could get down into this 10,500, possibly into this 9,100. So I would say that we would be looking at something maybe a little like this before we find some support down in this area. And that would again complete our longer term whoops, let me try that again. A, B, C, D, E down to here. Now, if we take a look at this from a trading perspective, we need to be cautious of the next wave, which again, I told you is going to be potentially an upward wave. And this is where it comes into play. So we have these charts over here that I've drawn quite a bit of data on for updates with everyone. And from a longer term perspective, what I'm really thinking is this is the ES, the S&P E-mini futures contract, that we're going to be looking at a base down in this area. This is 3488, finding some support, coming back up into the 4,100, 4,000, 4,100, which will get everyone super excited, roll back down to potentially a low back in this area, and then begin a move higher. Now, my timing might be off, but this puts us into November 2023 to let the markets unwind. And that means we need to be cautious of some rotation here, because as the Fed is trying to unwind this market, various asset classes are going to unwind. You're going to see houses move lower. You're going to see credit and debt markets change. You're going to see consumers really struggle. You're going to see spending slow down, which means that certain commodities might drop in price. Gold and silver, I think, will do very well. But understand that we've got, if my timing is correct, we've got essentially another 13, 14 months of this unwinding to take place before we get over into this area where we may see some sort of a bottom set up. Now, gold and silver are doing quite well. They're holding up extremely well through this period. They've actually established a new base here, which is incredible. Let's take a look at the Fibonacci system with gold and silver. So this is the gold chart. This is the Fibonacci system. This is weekly. You can see the next upside targets are 2,400. The immediate upside target is here, 2,115 roughly. We are holding up. We're above the bullish trigger level here. We're looking for confirmation of this trend. We're also below this bearish trigger level here, but we're holding up extremely well, and we're really looking for new highs. I think this is a very good bottom setting up in gold. Trending, though, it is still bearish, is still telling us the trend is bearish. We don't have any confirmation of an upward trend yet. And with regards to silver, I don't think I have silver there. Silver is, let's see where the lines come up. There we are. Silver is consolidating excessively down near this 22 level, just below 22. We've got very solid bottoming after this extreme washout. You can see longer term that we've got some really great rotation here and upward trending. In fact, we're probably very close to a 50% retracement level. Let me just try this. Let's try to shrink this down. From that level to that level, we are right at a 50% retracement level, just off of the 50% retracement level a couple weeks ago in silver. We're looking for upward confirmation, and that's going to come with a follow through of this base here, which you can see the trigger levels way up here. This is because of the adaptive modeling system. It's telling us that we've had a lot of rotation. We're not going to get a solid trigger in this until we get another rotation in price, tightening this back down. Right now, we need to get above $30 in silver to actually confirm on a Fibonacci price structure that this is bullish on a weekly basis. If we come into daily, we'll get a lower trigger, hopefully. Yep, we have a lower trigger right down here. It's actually still bearish right now, looking to go bullish on this nice move up, and our targets up here are 24, 26 and 24.72. So with regards to all of this, we have a broad shift in the way the markets are going to work. And again, taking a look at this gold setup, I want you to understand that we had this apex set up, then we had a secondary apex. Now, if I were to do this and try to draw this for you, understand that we now have a new apex level setting up here, which is very close to, and I'm going to try to expand this out. Very close to reaching a critical mass, let's call it. Gold is going to try to make a move here. You need to be aware of it. This is a very solid setup for gold. It is, like I said, going to try to make a big move here. And missed it again. Okay, and if we spread this out, let's take a look. We'll come up 1, 2, 3, 4. I think it's reached its end, and I think gold is about ready to make a massive move. How am I counting that? How am I expecting that? I'm taking a look at this from a standpoint of a pennant formation from this low here, new higher high, new higher low. I'm counting it as 1, 2, 3, 4, and now up, up and away. So here we go. This means that metals look really strong. Gold and silver and platinum look very, very strong. I think we could see a very big move to the upside, and I think other asset classes are going to start to really devalue. So watch houses, watch consumer credit. I'm already watching foreclosures. They're starting to pop up out here in California well, at least in the areas that I'm looking in, Orange County, LA, and Riverside County, they're popping up a lot more frequently, but not flooding the market yet. I say give it about 6 more months, and we should be flooded with foreclosures and people that are upside down on their house, possibly getting laid off, and we'll see how it plays out. But right now, from a trader standpoint, the S&P, ladies and gentlemen, must hold these lower levels, must hold this, let's call it 30, let's call it, actually I don't think it's got much of a chance to hold these levels here. Let me come in here and take a look. I don't think it's going to find any support, honestly, at this point. I don't think it's going to find any support until it reaches down here in the 35.25 area. I really think the S&P is just going to continue to melt lower. I think it has enough momentum. You can see volume is high. I think it has to migrate down into this area and try to find support in this 3,500, 3,470, 3,525 area, and then we will start to see that end of the move. And that's because this is a 100% measured move from this. So understand that if we take this, which is the same as this, it's exactly the same. If we take it from this point to this point, try to get it to line up, that means that we have to get somewhere down here into 3440, 3450 before we really try to find some support. Okay, that's the update for now. So now we're going to watch this. Everybody understand opportunities will come. This next move here in the SPY would likely be, oops, get my chart back. The next move here in the SPY will likely be a bit of a sideways upward move and prolonged. This is the extended phase 3 of an excess phase peak pattern. We're seeing the initial breakdown move. The next move is going to be to kind of roll and base, and we'll see how that plays out. If everything does what the Fed wants, we get kind of a move away from excessive inflation, we may start to see some real growth out of this. But for right now, we got to wait and see. We're very close to the end of this move. If we take a look at this, the S&P has to move about 6.5–7% lower, which is about 230 points lower. And then we reach the end of the move. And that means that we're going to be looking for a bottom over in this area. Don't start bottom hunting until we get down below, say, 35. That's where I think the bottom's actually going to come in and play. All right, that's it for now.